Namaste, this is CA.Lakshman Jijnasu. In this video, we'll discuss about India's 23 that talks about borrowing cost. Borrowing cost is a significant expenditure for many business entities, particularly entities those are in construction or expansion phase. Accounting of borrowing cost has a significant impact on the financial position as well as the financial performance of any entity. The core principle of borrowing cost is that in case of the operating expenditures, it is recognized as an expense. But when borrowing cost is incurred, particularly for the purpose of acquisition, construction, or production of a qualifying asset, in that case, this borrowing cost is to be capitalized. Qualifying asset is an asset that takes a substantial period to get ready for its intended use or sale. The terminology substantial period is not defined in India's 23. It may be less than 1 year also, it may be more than 1 year also. So it's a matter of judgment what the substantial period is. So the core principle about the borrowing cost is that normally it is recognized as an expense. However, if borrowing cost is particularly for the purpose of acquisition, construction, or production of a qualifying asset, in that case, we need to capitalize the borrowing cost. Borrowing cost, there are some exclusion. For example, actual or imputed cost of equity, including the preferred capital that is not classified as a liability, is out of the scope of India's 23. So it means the actual cost or imputed cost of equity and the cost for the preference shares that is not classified as a liability are out of the exclusion, and these costs will not be considered for the purpose of capitalization. Because the cost of equity means the real or direct return that we have paid to the equity holders. So it is considered as a distribution of the profit, not interest cost. So it is not covered by India's 23. India says that equity shareholders do not lend their own. They cannot give the loan to their own. That's why it's not a borrowing cost. So another terminology that is used in this is imputed cost of equity. What is the meaning of imputed cost of equity? Imputed cost of equity means that is not actually paid but theoretically estimated or deemed cost. For example, a company that finances a project entirely from its own funds without taking any loan. So someone may argue that if we had borrowed, we would have paid 10% of interest. So let's treat 10% as an imputed cost of equity and capitalize it. So here in the exclusion clause, India specifically says that imputed cost of equity is out of the scope of India's 23. It says that you cannot capitalize or expense this because it is a notional cost. So you cannot record a cost just because you could have borrowed. Accounting deals with the real cost, not the imagined one. And borrowing cost apply only to the liability, not the equity. Dividend or expected return on equity is not a borrowing cost. Preference share dividend, it will be included in the cost of equity only if it is classified as liability as per India's 32. For example, if 10% preference shares classified as liability, so interest on the preference share will be considered as a borrowing cost. And if it is classified as equity, it will not be considered as a borrowing cost. So why there are these exclusions? Because cost of equity represents ownership. It is not an obligation of an entity. And borrowing cost must arise from a liability as per India's 32. Therefore, actual dividend as well as the imputed cost are excluded from the borrowing cost India's 23. There are two types of optional exceptions also. India's 23 allows entity to escape capitalization of borrowing cost in two special cases, because in these cases capitalization will either add no value or is impracticable to apply. First is qualifying asset that is measured at fair value. If a asset is measured at fair value, there is no need to capitalize it because it will result into no value to the organization, because ultimately asset is to be going to be measured at fair value. Some qualifying assets like biological assets, those are measured at fair value, not at cost, since their value changes every period with the market fluctuation. So adding interest cost is meaningless. For example, plantation trees, tree bushes, and grapevines, cattle, etc. These are to be measured at fair value. So if we add the interest cost to their historical cost, it is not going to give any value to the organization because it's meaningless. Ultimately, the plantation trees or tree bushes, etc., will be measured at fair value, not at the historical cost. So therefore, Ind AS 23 says that you may ignore capitalization for such assets. So the hook line is when fair value rules the game, capitalization take a back seat because the market already decides the value. Second case is inventories, those are produced in large quantity on repetitive basis. So in these cases, Ind AS 23 allows for the optional exception because production is going on in repetitive basis, and there is no logic to connect the borrowing cost with each and every asset. So some industries continuously manufacture large volumes of identical inventory, maybe concrete, cement, sugar, chemicals, FMCG goods, etc. And each unit's production cycle is short and repetitive. So tracing the borrowing cost to each batch would be impractical and immaterial. So it is impracticable to apply Ind AS 23. So logic behind is that some production is ongoing and repetitive and borrowing cost is treated as a periodic cost because it is impractical and immaterial to trace the borrowing cost to each batch. So Ind AS allows us, gives an exception that you are not required to capitalize borrowing cost in these cases. Because capitalization makes sense only for the unique or long duration inventory. Otherwise, the management of capitalization in respect of the inventories, those are frequently produced and sold, will be difficult. So it says that the capitalize the borrowing cost only in case of the unique or long duration inventories like shipbuilding. It takes 3 years to 5 years of making one asset, one inventory shipbuilding or aircraft manufacturing. However, if we are manufacturing the steel, sugar, cement, it will be difficult to correlate the borrowing cost with the inventory that is produced. So it says then when production runs non-stop and repetitive basis, changing borrowing cost per unit is like counting drops in ocean. So India's 23 spares you from that trouble. Next is the borrowing cost. So borrowing cost is a interest and other cost. Other cost may be transaction cost or premium, etc. And interest expense calculated using effective interest rate. And interest in lease as per India's 116 and exchange difference on the foreign currency. So exchange difference on foreign currency we'll discuss in detail in next slides. And expense calculated using effective interest rate as per India's 1109. For example, we have taken a loan of 100 crores and rate of interest is 10% and processing fees is 5%. So net cash flow that we received is 95. 100 is a loan and 5% is the processing fee. So net debt amount we will receive is 95 or 95 crores. So in this case, outflow will be 100 crores of loan and 10% of interest. So cost of borrowing will be 15 crore, 10 crore as a interest and 5 crore as a processing fee. So the effective interest rate will be 15 crore we have paid and 95 crore that what we have received. So 15 divided by 95, it is 15.79% will be the effective interest rate as per Ind AS 109. So it includes borrowing cost includes the exchange difference on the foreign currency. So what is the meaning of exchange difference on the foreign currency? So it is exchange difference on foreign currency can be treated as a borrowing cost only to the extent they are regarded as an adjustment to the interest cost. So exchange difference on the foreign currency to the extent they are regarded as an adjustment to the interest cost will be treated as a borrowing cost. What is the meaning of it? For example, there is a loan amount of 1 crore that we have taken in USD and interest rate in USD is 6%. And interest rate, if we would have borrowed in India, is 12%. And the exchange loss due to the exchange rate difference is 5 lakhs, sorry. So if the foreign loans amount, interest plus exchange rate difference is 12%, same as the Indian borrowing rate, then 5 lakhs can be considered as a borrowing cost. But if the interest plus the difference bit of the exchange rate is higher than the 12%, in that case, we can capitalize up to difference of both of the interest rate. So any loss beyond that difference, we need to treat as a forex loss, P&L, not as a borrowing cost. So idea is you cannot capitalize more than what you would have paid in INR. So normally companies take the loans from the foreign companies because there is a difference in the rate. For example, in India, there is a rate of loan at 12% and in out of India it is 6%. So India's 23 says that if there is a loss due to the exchange rate difference, so in that case, to the extent of Indian cost of loan, you can capitalize. And if there is a excess of the Indian rate, that we cannot capitalize. So hook line is the exchange loss joins the borrowing cost club, but only till it matches the Indian interest rate. So if there is a difference, if there is a loss due to the exchange rate, so to the extent of Indian cost of loan, it can be capitalized. So it says India's 23 says both the things. You can capitalize it to the extent of Indian cost of borrowings, but similarly, if there is a reversal, in that case, we need to reverse the cost also. When exchange loss earlier treated as a borrowing cost and later it is resulted in a gain, whether it is realized means when we have paid the cost, and unrealized when there is a only translation loss, there is no payment of the loan. So in this case, we need to reverse the cost also. In the first year, if we have booked the cost, and second year, if there is a gain. So India's 23 says that the gain must reverse the earlier capitalization to the same extent. For example, in year 1, there is a exchange loss of 3 lakhs that we capitalize. And year 2, there is a exchange gain of 2 lakh. In that case, we need to reverse the 2 lakhs, reduce the 2 lakhs from the borrowing cost that we have capitalized earlier. So the hook line is if the loss was once treated like interest and later gain must play the fair, we must reverse the gain. So we need to reduce the capitalization by the gain amount to the extent of the loss we have booked earlier as a capitalized cost. So let's understand this concept with the help of example. ABC Limited has taken a loan of 20,000 USD on April X1 for the construction of a plant. So this loan was taken for the construction of a plant as an interest rate of 5% per annum on annual basis. On April X1, the exchange rate between the currencies in USD versus rupee was 45 rupees per USD. The exchange rate on the reporting date, March X2 was 48. So at when the loan was taken on April X1, the conversion rate was 45, but at the financial year closing, the rate was 48. The corresponding amount could have been borrowed by ABC Limited from State Bank of India in local currency at an interest rate of 11% on April X1. So local borrowing rate is 11%, while we have taken a loan at 5% from the outside out of India. So we need to compute the borrowing cost to be capitalized for the construction of a plant by ABC Limited for the period ending March 31st X2. So as per principle, we can capitalize the difference of exchange loss to the extent of Indian cost of borrowing. So let's understand. It is given in the question that loan is of 20,000 USD. Date of loan is 1st April X1. Interest is it's 5%. So on this basis, the interest would be 1,000. Exchange rate 45 at the date of loan, and at the end of financial year it is 48%. Equivalent INR loan interest rate is 11%. So actual interest cost on the foreign loan is 1,000 USD at the rate of 5. So wow, sorry, 5% at a loan amount is 20,000, so 1,000 USD, and the year end rate is 48. So actual interest on the foreign loan is 48,000. Exchange difference on the principal. When we took the loan, the rate was 45, but at the end of the financial year, it is 48. So there is a 3 rupees increased in the dollar rate. So the borrowing has been increased by 60,000 rupees. 20,000 into 3,000. So total cost from the foreign loan is 48,000 of interest plus 60,000 of a translation loss. So the total cost is 1,08,000. Now we need to calculate what will be the interest rate if we would have borrowed in the INR. So in this case, 9 lakh into 11%, that is 99,000. So compare actual foreign versus local interest. So only 99,000 is considered equivalent to the borrowing cost. The excess 9,000. Here total amount in foreign currency is 1,08,000. 48,000 for interest and 60,000 exchange loss. But in Indian currency, if we would have borrowed, so 20,000 USD at the rate of 45 rupees per USD, and interest rate was 11%. So it would have been 99,000. So up to 99,000 we can capitalize, and 9,000 we need to treat as a expense in P&L. So actual interest or forex loss is 1,08,000. Notional interest cost 99,000. Difference is 9,000. So interest foreign plus foreign exchange difference we will capitalize as a borrowing cost 99,000, and remaining the difference we will charge to P&L 9,000. So borrowing cost to be capitalized is 99,000. Exchange loss to be expensed off is 9,000. Next is about the qualifying asset. So qualifying asset is asset that takes a substantial period for getting ready for intended use or for sale. So Ind AS 23 does not define what is the substantial period. So this term is judgmental and depends on the nature of the asset in industry practice. It may be less than 1 year also. It may be more than 1 year also. So qualifying asset is a asset that takes substantial time for getting ready for intended use or for the purpose of sale. It may be inventory if production takes longer time. For example, wine aging, ship buildings, aircraft buildings, etc. It may be manufacturing plants under construction phase, power generation facilities, for example, hydropower, solar parks, etc. It may be intangible assets, software development projects, etc. Investment properties or bearer plant, like tea bushes, our trees which bear produce more than 1 year. And there are some exclusion from the qualifying assets. Those are financial assets, always excluded, shares, bonds, loan, etc. And inventories, those are produced quickly, are excluded. This is an optional exclusion. For example, cement, sugar, etc. and ready to use assets are excluded because as per the definition, qualifying asset takes a substantial time. If the asset is ready to use, it is excluded from the definition of qualifying asset, and the borrowing cost on the ready to use assets are not capitalized. It is treated as an interest expense in the P&L. Let's take few example on it. A telecom company has acquired a 3G license. The license could be sold or licensed to a third party. However, management intends to use it to operate wireless network. Development of the network starts when the license is acquired. So identify whether the borrowing cost on the acquisition of 3G license can be capitalized until the network is ready for its intended use. So as per the definition of qualifying asset, it takes the substantial time for getting ready for intended use or for the purpose of sale. So the purpose management intend to acquire the license was to operate a wireless network. And this wireless network is a qualifying asset. And wireless network takes a substantial time. Development of the network starts when the license is acquired. So the purpose of acquiring the license is to operate a wireless network. So in this case, we can capitalize this as a borrowing cost. License has been exclusively acquired to operate the wireless network. Fact that the license can be used or licensed to a third party is irrelevant here. The acquisition of the license is the first step to wider investment project. So it is a part of network investment which meets the definition of a qualifying asset. Next is a real estate company has incurred expense for the acquisition of permit allowing the construction of a building. So they have incurred expenditure for acquisition of a permit to construct a building. It has also acquired equipment that will be used for the construction of various buildings. Examine whether the borrowing cost on the acquisition of the permit and the equipments to be capitalized until the construction of building is complete. So as per the definition, qualifying asset that takes a substantial period for getting ready for intended use and for sale. So in case of the permit, yes, we need to capitalize because permit is specific to a one building and its first step is a wider investment project. It is a part of construction cost of building which meets the definition of the qualifying asset because construction of building is going to take a substantial period of time for the intended use. However, in respect of the equipment, those are not specific to a particular asset. Here, while checking about the capitalization of a borrowing cost, we need to first identify that borrowing cost is in respect of qualifying asset. So, in question, first we need to identify what is the qualifying asset. In this case, building is a qualifying asset because it is license is obtained for the purpose of building, and building is going to take a substantial period of time for getting ready for intended use. But in case of the equipments, It is to be used for various buildings. It is not specific to a particular building. So here it will not be capitalized because it does not meet the definition of qualifying asset. Is interest on a financial lease of a qualifying asset is capitalized as a borrowing cost? Yes. Interest incurred on a finance lease is specific to an asset, and interest is capitalized if assets is a qualifying asset or is used solely for the construction of qualifying asset. Next is the recognition of borrowing cost. So only those borrowing costs, those are directly linked to a qualifying asset, are being capitalized, and all other borrowing costs will be charged to P&L in the period they have incurred. So this ensures that interest cost become part of the asset only when it is contributes to creating that asset. And other general borrowing costs are expensed. For example, if loan is taken for a factory construction, then we need to capitalize it because the loan cost is directly attributable to qualifying asset. And if loan is for working capital or paying to the supplier, we need to expense it off because it is not linked to a assets construction. And loan for buying or ready to use machine, we need to expense off because as per the definition, qualifying asset is something that takes a substantial time for getting ready for intended use or for the purpose of sale. But in this case, the asset is ready to use, so it does not fall in the definition of qualifying asset. So hook line is the only interest that helps build an asset deserve to live as a part of its cost. Rest dies in P&L. What is the recognition criteria in case of borrowing cost? So we need to check for two tests. First is the probability test, whether asset will generate future benefit for the entity. For example, a plant expected to produce sellable goods. It is going to give the future benefit. Another example, building under construction financed by a loan. So it will be expected, it will be used for the manufacturing. This is a probable benefit. And interest rate and expenditure are clearly known. So it is a measurable also. So we need to capitalize the borrowing cost. Another example of probability that future benefit will generate to the entity or not is R&D project with uncertain future. We are not supposed to capitalize the borrowing cost because it fails the probability test whether it will generate the future benefit for the entity or not. Another is the reliability test. It means the borrowing cost and related expenditure can be measured reliably. So in this example that we discussed, that interest rate and expenditure, those are clearly known. It is measurable. So it will be capitalized. And there is a specific case in respect of the hyperinflationary economics. In this case, when entity applies India's 29, it recognizes as an expense the part of borrowing cost that compensate for the inflation. Similarly to the interest uh, exchange rate difference. Next is borrowing cost that is eligible for capitalization. So we capitalize only the portion of interest that will arise because you are constructing a qualifying asset. If that asset does not exist, we would not have borrowed that money. So judgment will be required to check when it is directly linked to the link funds to the asset. So when capitalizing the borrowing cost, the funds should be specific. For example, loan taken specifically for a building plan. So this is clearly attributable that loan is taken for a building. So we need to capitalize the full interest. However, if there are different type of loans, there is a no specific loan that is taken for the construction of the building, but it is construction of building is funded from a pool of the borrowings that we have taken. In that case, we need to apply the weighted average capitalization rate for the purpose of the capitalization. So in case of general borrowings, those are not directly attributable. We need to apply the weighted average capitalization rate. And if loan taken after the asset is ready for use, so it will be expensed off in P&L. It will not be capitalized because borrowing cost, as per definition, it is for the purpose of the qualifying asset. And qualifying asset is that takes a substantial period of time for intended use or sale. So in this case, the loan is taken when asset is ready for the use. So this asset is not a qualifying asset. So because of that, the borrowing cost that we have incurred, we are not supposed to capitalize. We need to expense it off. So when funds are mixed, we need to calculate the interest capitalization based on the if specific loan, it is based on the actual cost less temporary income. And in case of general borrowings, we need to use the weighted average rate into qualifying expenditure. In case of specific loan for the qualifying asset, we will use the actual cost less temporary income. If because of the non-utilization of amount for some period, we have invested that amount and have earned some income out of it. So when capitalizing the cost of borrowing, we will reduce that income from the actual cost. So we will capitalize only the net cost. Borrowing cost minus the income that we have earned by investing those unutilized funds. But this rule is specifically only for the specific loans. It does not apply on the general borrowings. And when to start the capitalization, there are three conditions that we need to check. That money is being spent on the qualifying asset and borrowing cost has started and construction or production activities active. All three must be there, must exist simultaneously. So first condition is that we have spent money on the qualifying asset, borrowing cost start accruing, and construction activity has started. For example, on 1st January, we have purchased the land and loan was not taken. So there is a no question of capitalization because there is a no borrowing cost. On 1st March, we have taken the loan, construction started. So all three conditions have been met. Because construction has started, it means that money is being spent on the qualifying asset. Expenditure is being done. Borrowing cost already started because we have taken the loan. And construction or production activity is active. Next is on 1st June, loan interest charged were continued. So in this case also we'll continue the calculation. So let's take few examples on it. X Limited is commencing a new construction project which is to be financed by borrowing. The key dates are as follows. 15th May, X1, loan interest relating to the project started incurring. So on 15th May, X1, borrowing cost has started. So we need to identify the commencement date for the capitalization of borrowing cost. Okay. So 15th May, borrowing cost has been started. So there were three conditions to start the capitalization: that money is being spent on the qualifying asset, borrowing cost started, and construction activity is activated. So on 15th May, only second condition is fulfilled, that borrowing cost has started accruing. There is no money spent on the qualifying asset and no construction activity or production activity has been started. In respect of 2nd June, X1, technical site planning commenced. So again, let's check three conditions. The money is being spent on qualifying asset? No. Because till 2nd June, we have not spent any of the money. So this first condition is not fulfilled. Second condition was borrowing cost started accruing. Yes, it has been started accruing. Construction of production activity is activated. No. So only one condition is satisfied on 2nd June X1 also. So for starting of capitalization of borrowing cost, all three conditions should be fulfilled. So here we cannot start capitalization of borrowing cost. Let's check next date, 19th June X1. Expenditure on product project started incurring. So here, let's check again. The money is being spent. Yes. Borrowing cost started. Yes. Construction of production activities activated. Yes. Because the money has been started to incur. So activities have started. So 19th June X1 is the date when the borrowing cost capitalization will initiate. Let's check. Commencement date is 19 June because India says the capitalization of cost begins when all three conditions are satisfied. Borrowing costs are incurred, expenditure for assets are being incurred, activities that are necessary to prepare the asset for its intended use are in progress. So 15th May, only one condition is satisfied. 2nd June, activities necessary have been started, and 19 June second condition is also satisfied that expenditure on project started. So on 19 June all three conditions are met. So capitalization commences from the date. Construction started on 18 July is a later or does not delay commencement once the three conditions are satisfied. So we'll start capitalization on the date of 19th June. So we have discussed about the borrowing cost eligibility, when the borrowing cost capitalization will start. Next is suspension of capitalization. We need to pause capitalization when there is a no significant work is happening on the asset. But the temporary or routine delays like monsoon break or short material shortage, we are not going to suspend the capitalization of borrowing cost. For example, if there is a situation that construction halted for 3 days because of the supply delay, so it is for the short duration, so we will continue the capitalization. But if there is a strike for 4 months, so duration is considered as a long. So in this case, we will suspend the capitalization because there is no significant work that is happening in respect of the construction of the asset. So we need to suspend the capitalization, and we need to expense of the borrowing cost of these 4 months. If there is a routine maintenance pause because of this construction was stopped, activities was stopped. So this duration is of short, so we will continue the capitalization. And if there is a government approval pending for 6 months, so it is this duration is long and we are supposed to suspend the capitalization because the fund that is borrowed for the purpose of construction of a asset, the cost of that cannot be capitalized because there is a delay, abnormal delay in continuation of the production activities, construction activities. So we need to expense of it. These costs are not supposed to be capitalized. So if the borrowing cost during idle period does not create a value for the asset, so it must be expense of in that period. Next is C is the capitalization. We need to stop the capitalization when asset is ready for the intended use. And if there is a some minor work is pending, formalities are pending, we need to stop the capitalization of the borrowing cost. Small finishing touches, they do not justify continuation of the capitalization. If an asset is built, for example, if an asset is built in the section and each section can be used independently, we need to stop capitalization for that completed section. For example, if different buildings are being constructed For example, loan is taken for construction of 5 buildings and one building is ready for intended use. So in that case, the borrowing cost for purpose of construction of that one building should be stopped. Capitalization should be stopped in respect of that building, and for remaining 4 buildings, borrowing cost will be capitalized. For example, factory building ready, machine installed and tested. We should stop the capitalization because assets are ready for intended use. Building completed, only landscaping pending. We should stop because this is a minor finishing. Next is housing complex built in phases, first tower ready. So C is for the capitalization, C is for the completed tower, and each part, because each part is usable independently and the part those are still under construction, we need to continue capitalization of borrowing cost. And ongoing administrative approval, so we should discontinue the capitalization because there is an administrative delay only. So let's check few examples. A telecom company has acquired 3G license. License could be sold or licensed to the third party. However, management intended to use it to operate a wireless network. So development of the network start when license is acquired. So whether borrowing cost on the acquisition of 3G can be capitalized until the network is ready to use. Yes, we can capitalize it because license has exclusively acquired to operate the wireless network. This example we have earlier discussed. Real estate also we have discussed. This also we have discussed. Then on 1st April, X1 borrowed 30 lakhs at the rate of 9% to finance the construction of two qualifying assets. The construction started on 1st April X1. The loan facility was availed on 1st April and was utilized as follows. For the remaining funds invested temporarily at a 7%. Okay. So for building factory and office building, for building of these two assets, 30 lakhs was acquired at a rate of 9%. And first utilization was on 1st April and second utilization was on 1st October. And during this period, the remaining fund, unutilized fund were temporarily parked at a rate of 7%. So borrowing cost at 10 lakhs into 9%, this is 90,000. And for this office building, 20 lakhs was taken at a rate of 9%. So 1,80,000 is the borrowing cost. But in this case, the examiner says, question says that the fund was invested temporarily at a rate of 7%. So in this case, 5 lakhs were temporary invested and used on 1st October. So 1st April to 1st October, 6 months. In both the cases, the funds were invested at a rate of 7%. So as we have discussed, that if any income is there on the specific borrowing, so we need to reduce the cost of the income on those unutilized fund that we have invested from the cost of the borrowing that we are going to capitalize. So in this case, the investment income is 5 lakhs at a rate of 7% for 6 months in both the cases. So we will reduce this income. So net cost is 72,500 for factory and office building, 1 lakh 45,000. So this borrowing cost we will capitalize 72,500 and 1 lakh 45,000. Next is Beta Limited had following loans in the place at the end of 31st March X2: 18% bank loan, 16% term loan on X1 and X2. The 14% debentures were issued to fund the construction of a building. Okay. So this is specifically for office building. On 1st July, they have issued, but the development activities have not yet started. So three conditions have not been fulfilled in respect of the debentures. Okay. So on 1st April X1, Beta Limited began the construction of a plant being a qualifying asset. Okay. So this plant is qualifying asset, and this office building is out of the scope because three conditions of capitalizing the loan has not been fulfilled. First is the money is being spent. Yes, money it has not been fulfilled. Borrowing cost start accrual. Yes. The construction of production activity is activated. No. So debenture cost is not to be capitalized. Let's see about the next asset is plant being a qualifying asset using the existing borrowing. So for the purpose of plant, they are using general borrowings. The expenditure drawn for the construction was 5 lakhs on 1st April and 25 lakhs on 1st January X2. So in case of the general borrowings, as we have discussed, that we will use the weighted average capitalization. So in this case, total borrowing is 10 lakhs at a rate of 18% and 30 lakhs at a rate of 16%. So total is 40 lakhs. So weighted average rate is 10 lakhs into 18% and 30 lakhs into 16% divided by 40 lakhs total borrowing. So it is 16.5% is a average rate. So capitalization of borrowing 5 lakhs that were drawn on 1st April X1 for full year 82,500 and 25 lakhs that was drawn on 1st January for 3 months. So at a rate of 16.5 for 3 months, it will be 1 lakh 3,000. So total borrowing cost that will be capitalized will be 18 lakhs, 1 lakh 85,625. Next is about the disclosures. So the amount of borrowing cost capitalized we need to disclose and the rate that we have used for the borrowing cost capitalization purpose will be disclosed in the financial statement. So this is all about the India's 23 borrowing cost. If you have any question or need any clarification regarding the borrowing cost, you may discuss on the WhatsApp number given on the screen. Thank you very much. Namaste.